Hey there, everyone. Happy Friday, November 1st, and welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you live from a rainy but beautiful Redmond, Washington here, first day of November. Nice sort of update for stocks today, recovering a bit in some small way from Thursday's bloodbath of a down day, sort of, I think leaving plenty of open questions going into next week. We've digested a ton of earnings this week. Next week, it's going to get into the elections, the Fed meeting, more economic data. There's going to be plenty of potential catalysts to continue on with now that we're sort of wrapping Q3 earnings and look forward now to the major themes between now and year end. As always, in the course of our shows, we bring a lot of questions, and I appreciate so much you guys asking some really thoughtful questions during our live streams. As a reminder, when we show the show live, you can ask questions as we go, and we try to take a couple at the end of the day. But by the end of the week, we've built up some really good questions, and we don't have enough time to go through all of them. So I like using Friday's show to sort of go through the mailbag and pick some of the ones that I think would be helpful and instructional, just informative to kind of review together. So with that in mind, let's get to the first question. Dave, can seasonality be used as a standalone trading system? So it's a really interesting question, actually, and the answer is yes. I mean, it could be. The real question, I guess, is should it be used, or is it a good trading system? And that's where I think it's a little more nuanced in terms of the answer. I mean, the short answer is you can use anything you want. What does it actually do? So here's the thing, right? I mean, if you look at the traditional seasonality in the S&P 500, and shout out, by the way, to the guys at the guys and women at IBD. Investors Business Daily. I just did IBD Live earlier today with Justin Nielsen, David Saito Chung, Mike Webster. Really, I mean, what a fantastic group of people. Just the nicest people. And it's easy to laugh a lot talking with them, but just a fun conversation about the markets. And the reason why it comes to mind right now is because we actually ended with this chart. We talked about this chart toward the end because someone asked about seasonality. This is the seasonality in the S&P 500 going back the last 20 years. Here we go. So, can you use this? Because this is basically the histogram gives you the batting average. So what percent of the time the S&P has been higher in each of these months going back for the last 20 years. And then the little numbers at the bottom of the histogram represent the average return or the mean return for all the, the Decembers going back 20 years kind of thing. If you look at like October, November, December actually tends to be remarkably strong. August, September, October tends to be relatively weak. The weakest month of them all on a batting average basis is January, with a coin flip, basically up half the time, down half the time. The average returns the weakest in January, June, and September. Here's the thing. If you look at what's happened in 2024, it has not particularly followed this seasonal pattern very well. Even if you zero in and look at more of the election year pattern, it hasn't really followed it that well. Having talked to a lot of different strategists and investors about this particular topic over the years, I will summarize my conversations, and I would agree wholeheartedly with the general consensus I received from some really knowledgeable technical analysts and money managers. Seasonality is best used as a backdrop, right? As a frame of reference, as a general sense of what's going on. And I will say a couple things to add to that. Jeff Hirsch, whose father Yale Hirsch really popularized this idea of calendar trends and seasonality. He founded the Stock Traders Almanac, and now his son Jeff Hirsch has kept that going and built on Yale's work and continues it to this day, which I highly recommend. It's a fantastic resource on seasonal tendencies. But if you, having talked with Jeff and interviewed him a number of times, he would tell you that is sort of the base case, barring some unusual inputs. What you have to remember is normal market environment. We have random new things that come in, right? There's a war out of nowhere, or an unexpected one, or the scale is more or less than expected. Elections all of a sudden make things look very different. A Fed rate cut cycle, which is very different. Earnings. Economic data, COVID, all of these things sort of happen outside of that normal seasonal tendency, right? The market might be moving not just because it's September, but because the Fed is starting to lower rates. And that means investors are excited about or anxious about or nervous about inflation or some other thing. So his his way of using seasonality, and I would argue he's sort of the expert in the modern era, would say that it's a backdrop, but you also have to apply, and analyze the markets themselves and recognize that the trend is what's most important. That's come out of a lot of my conversations that I've had, is that seasonality is sort of the general tendency. It's not a rule; it's a tendency. John Kosar of Asbury Research describes it as when you're riding your bike and you're riding into the wind or the wind's behind you, right? If you're riding into the wind, you still make progress. It's just a lot tougher. And when the wind's at your back, it's just things are easier. And that's kind of how I would think of seasonality. Is the wind at your back, or is the wind, are you riding into the wind or away from the wind? And, again, things can do different things than the election or than the seasonality would expect. So follow the trend primarily. Having said that, like, there are some ETFs that actually, and one in particular, it's the Sam Stovall one called, what is it? Here we go. The Pacer CFRA Stovall Equal Weight Seasonal Rotation ETF. This is an ETF that actually tries to play that seasonal pattern. And I think from November through April, it's in kind of traditional offense, like consumer technology kind of things. From May through October, it's more defensive things like utilities and consumer staples. It hasn't done particularly well on a relative basis in 2024 because essentially the market's been strong. So if you've been out of offense, if you've been out of the AI trade just because of the seasonality, then you missed on some of that upside. So those are some thoughts about your question. So can it be used as a standalone trading system? This is an ETF that actually tries it. You're welcome to dig into it. And again, it's not, there are many ways you could play that. This is just one way of looking at sector tendencies based on those seasonal headwinds or tailwinds. In my experience, though, selling just because it's, August, or buying just because it's November, I don't know if that means a lot to me. Buying or selling because the trends tell you to do so, that we are going to be 100% in agreement on. Thanks for that question, by the way, and having me dig into seasonality a little bit. All right, next question. If a volatile stock with high swings is setting up for a swing trade but has poor financials, do you still enter the trade? Ooh, that's a real good question. So remember, my answer is going to be more of a generalization, right? And so I'm speaking generally about how I would do it. If you are on a swing trading time frame, I would argue fundamental data does not help you a whole lot, right? A swing trading time frame, we're talking about a couple days to a couple weeks at most, right? Which means you're kind of looking at a shorter period of time. That's probably even, just not a great chart. Here we go. So, you're just trying to bet on some of these short-term swings, right? And buy low and sell high. So even if the trend is higher, you're just trying to like kind of pick entry and exit points along that trend. There's not a lot of fundamental data that's going to come out through the course of a 6-week period, unless you kind of go right through earnings season, which you probably, arguably don't want to do as a swing trader. You probably want to bet normal volatility, right? When you're a swing trader, you're playing the normal mean reversion that happens. A stock trades to its fundamental valuations. At least this is the generally accepted reality of stocks, and not completely accepted, but this is what I would argue, is that over time stocks trade to their fundamental valuations. That's kind of theoretically what equities should do, but the whole field of technical analysis is basically derived from the fact that stocks just don't immediately go to a new valuation. They kind of fluctuate, right? Even though the trend overall is positive and the stock is gaining ground, there are these little kind of peaks and valleys that happen along the way, right? And you can see that on any chart, right? Look at our daily chart of the S&P 500. You can see those sort of price swings, though. Even though this year has been remarkably strong, there have been these little peaks and valleys that have happened. And so if you're trying to identify turns over a couple days to a couple weeks, I would argue looking at a balance sheet isn't going to help you answer that question at all, right? Because there's a lag, and that's quarterly data. I think you'd be looking for, that is a technical question you're trying to answer. So I would be looking at technical indicators to make that assessment. If you told me I'm trying to figure out what stocks to own for the next 5 to 10 years, I would argue look at a lot less charts and focus on companies that are growing earnings consistently over a long period of time. Look for companies that are paying a consistent dividend that you can rely on, right? So your time frame, I think, will be the most important part of how you answer that question. But since you asked about a swing trade, I don't think a stock with poor financials should scare you at all. You're betting on mean reversion, right? You're betting on the fact that regardless of where the fundamental valuations are in the future, you're betting on the fact that it's going to be a noisy ride between now and then. And for most stocks in most environments, a noisy ride is a pretty safe thing to bet on. So that's how I would answer that question. Good question. I love that. Made me think of that. All right, next question. Is there a short squeeze going on with App? I think AppLovin, I'm assuming, is the stock that you're talking about there, APP. Also, how does one tell if a short squeeze is happening? What clue in the chart tells us it is happening? Awesome question. Here's what I would tell you. The short answer is people love talking about short squeezes, and they often will attribute some move to a short squeeze. Whether or not the data actually supports that, or whether you could even have that data to even know that, is actually very difficult. Unless you have 100% transparency and you can actually tell that short sellers are covering positions. If you're a market maker, you have that transparency in a lot of ways to be able to tell, wow, this is a lot of people that are covering shorts. And having worked for a big institutional firm, you actually could, talk with trading desks and actually get a sense of what is actually moving the stock. Is it a big kind of whale coming in and accumulating shares? Is it a short squeeze? Are people getting caught on the wrong side of things? Like, what's going on? And you could get a better sense because they actually had transparency into seeing what big trades were actually happening. Average investor in 2024, it's really hard to do that, right? So when the general things that I would say, right, a short squeeze, just so we're all on the same page, right? If you're short a stock, you have borrowed the stock from your broker, you've sold it in the open market, you're hoping the price goes down so that you can cover your short or close out the position down here. You buy back the shares, you give them back to your broker, and basically you've, instead of buying low and selling high, you're reversing it and selling high first and then buying low. So you're doing the same thing, you're just reversing the order, and your broker's happy to lend you the shares you need to sell them and then buy them back and then give them back. And that's how it kind of works. I'm sort of summarizing the mechanics of it. So what happens is if a bunch of people are short, all of a sudden, if the price goes up, you get a margin call, or you get called out, meaning the position that you borrowed the shares and you've sold them. But if the price starts to go up, you're now underwater, and your broker at some point is going to go, hey, investor, you're going to have to pony up some money if you want to keep holding this ridiculous position that's losing aggressively. Or they might just say, you're now closed out and we're getting our shares back and you're eating the losses, and you have to give us this additional money to cover the losses in your account. So that is basically a trap that you can fall into if you're short a stock and the stock goes up a lot. So something like AppLovin, when you see a big rise, you could argue that if there are a bunch of people like shorting the stock at 90 and then we break out, you could argue probably that at least some of that, buying power, it might not just be new buyers coming in. It might be people that were short here. And when it starts moving up enough, they have to cover. And what happens is when you actually cover your short, it's just like buying shares, right? Because you have to buy them back to cover your short. And so that is basically another buy. So whether people are buying new long positions or covering short positions, it has the same net impact of the price going higher. So you could argue that that's probably something at work here. Now, there are short interest. There's short interest data that's reported. So if you Google, and StockCharts doesn't have a short interest database to speak of, but if you search on, and I know NASDAQ comes to mind as a place that actually has it. So here I actually just brought up AppLovin on just Google NASDAQ and the ticker, and you'll find in short interest, and you'll get to a page like this. This you can see, twice a month, the NASDAQ reports short interest for stocks that they are in their universe. Here are the number of shares that are short. Here's the average volume of shares. So you can see that the short interest is around 22 million shares. You can see the average daily volume is around 3.6 million shares. And that gets to this data point, which is probably one that you want to think about, which is called days to cover. How many days of average volume would you need for all of these short positions to actually cover? The likelihood of that actually happening is pretty low. It's just to give you a relative sense of how much of the shares outstanding or float are short versus long positions. And so stocks with a higher days to cover, stocks with a higher short interest as a percentage of shares outstanding much more likely to see a short squeeze just because you have a lot more people that are already short. So if the price goes up, they're going to get trapped on the wrong side of it. So that is one way. And again, it's hard to tell because, again, the last report is a couple weeks ago. So it's not super, up to date. But you can look at that and get a sense of whether a stock you're looking at is more likely to fall victim to that sort of move. And if you're long, and one of the best things to happen on a stock that you own is a short squeeze, where those short investors betting short are caught on the wrong side of it and to have to cover, and that just provides more upside to your long position. I hope that answered your question. I had to get into some random market structure kind of things, but I hope that helps. By the way, I mean, if you appreciate the work that I do, and if you like this sort of discussion about charts and investor psychology, some market structures, some market outlooks, and everything in between, I hope you'll consider my free course. It is free, so why not? If you go to marketmisbehavior.com/free course or scan the QR code in the coffee cup on the right side of your screen that you see, you can have access to my free investing course. It's behavioral investing. It's done over email. I have a video that I'll send you each week, an exercise, a little homework to challenge how you think about the markets. I call it the 5 modes of mindful investors. And over 5 weeks, I'll give you one topic, a video, an exercise. And I hope and I believe that you will come out of that free behavioral investing course, hopefully a reborn and new investor. And encourage you to check that out. Again, marketmisbehavior.com/free course. All right, let's continue on. Take maybe 2 more questions here to wrap out the episode. Dave, it's often said that the utility sector is a defensive sector, and I agree. But today, October 17th, didn't utilities go down because interest rates went up? Really good question. Let's look at that. So the answer to your question is right. I think the same. It kind of goes back to our seasonality comment. We love to generally define a sector as offense or defense, right? And just like we, classify seasonality as sort of like positive or negative, right? Is October a good month or a bad month for stocks? And the reality is there's a nuance, right? I mean, it's not black or white. It's sort of in shades of gray. So is utilities a defensive sector? Generally speaking, it is. Now, what makes it a defensive sector, right? I mean, I would say the reasons why investors tend to like utilities in a bearish market environment. Number one, they're lower volatility. And if you missed my podcast episode I released earlier this week with Ari Wald of Oppenheimer, do yourself a favor and listen to that one, because we talked about high momentum, low momentum, high beta, low beta, risk on, risk off, offense, defense, and talked about utilities in particular within the context of all of that. But utilities tend to be lower volatility, meaning if the market goes down 10% on a particular time, the chances of utilities going down 10% or more are pretty low, because utilities tend to have a much lower volatility. They move a lot less. So if the market's going down a lot, utilities just tends to go down a lot less. And so if you're concerned about the market going down and you have to own stocks, like you're a big money manager, you have to be fully invested, you buy utilities and, Pepsi and Walmart and tobacco companies, these big defensive names that are probably going to hang in there okay, because they don't tend to move as much. And if the juicy stuff, the tech biotech, crowd is going down aggressively, the chances are that utilities are going to go down less. So it's a lower volatility name, also tends to pay a higher dividend, which means even if the price is going down, at least you're getting a good dividend that can help compensate for that loss in capital, right? By the fact that your initial investment is lessening because of the price action. So utilities tend to make sense for some of those reasons. And as a result, if you look back over multiple market cycles, utilities tend to do pretty well in down markets. And I would argue that's because of those reasons. Now, utilities have done pretty well in 2024. I mean, on an absolute basis, the XLU, I would argue, is still in a primary uptrend, even with some choppiness we've had in the last couple of weeks. The relative strength, while not blowout impressive, is still not bad. From mid-February to mid-October, you've outperformed by owning the utility sector, so that's not bad. It's been interesting in 2024 that utilities have become a little more of a growth play, and that comes to all of the energy that's required to fuel AI that we're all using all the time now. That is driven by huge data centers that require a ton of energy to operate. That means utilities are more valuable because they're providing the energy. Same with Cryptocurrency, crypto mining, that requires a ton of energy. And again, utility companies are a big part of that story. So utilities are more of a growth industry all of a sudden. And that's kind of a novelty in the last 12 months that I've seen that become more and more part of our thought process. Particularly to your question on interest rates. Yeah, right. So if you think about it, if a 10-year yield if 10-year yield is around 5%, which it was earlier this year, and utilities are yielding 3%, I'd rather have the bond, which is basically risk-free and giving me a 5% yield, as opposed to a stock, which is not risk-free. There is some risk involved, and it's paying a lower yield, right? And you have the opportunity to, for the price to go down. But if the 10-year yield comes down more and more, a higher yielding stock is a lot more valuable, right? So AT&T at like a 5% dividend yield right now is better than the 10-year, right? So it's better off owning an AT&T where the stock price is appreciating and the dividend is still pretty good, and you're outperforming a 10-year, just because of that. So the higher that rates are, the less valuable kind of the income component to utilities and other defensive sectors certainly is. So, what does that mean on a one-day time frame? There are a lot of things at work that could be part of that narrative on that particular day you're asking about. But those themes that I'm talking about are really more longer themes, not as much about one individual trading day, but more generally speaking, those are the trends that you tend to observe. Great question, by the way. I appreciate it. All right, last one. Dave, I heard you mention you go down to the weekly chart to confirm if strength is coming into a particular stock. So I'm assuming a yearly chart to spot trends, then weekly chart to look for entries. Yeah, I don't know if that's exactly how I would describe it. So let me tell you what I mean. You're getting to, to summarize your question, right? How do you use multiple timeframes? 100% a valid question. I'll show you. I actually don't bring this up probably nearly enough, but in Stock Charts ACP, which is the advanced charting platform, I have this layout. I want to say this one. Yeah, maybe one of these, right? So like these are the kind of layouts that I really, really like. Boy, I really do need to use this more. Sorry, as I'm banging around with a bunch of charts. I mean, this gives you an idea of it, right? So right here, I'm actually looking at the daily chart, looking at a bunch of relative metrics for Apple versus the S&P and the industry groups and everything. Here, I'm looking at the monthly chart of Apple, the weekly chart of Apple, and then like a really zoomed in candle chart just to look at the short-term environment. Ideally, you're thinking of all these different time frames, right? So here I'm looking at, the last couple months. I'm looking at the last year. I'm looking at the last 5 years, and I'm looking at the last 20 years, right? And daily for the short-term timeframes, monthly charts for the long-term timeframes. The idea that if all you're doing is looking at like this daily chart of the S&P 500, you really don't have enough information to understand what the current move in Apple means relative to the broader kind of secular trend, right? This tells you the conditions in Apple over the last year or two, but it really doesn't tell you the story going into the last 2 years, right? What was happening the 20 years before that, right? What sort of overall trajectory is this stock in? Is this a long-term gainer? Was this a stock that was down for years and years, and then just the last 2 years is just like a huge bottom before this, complete recovery? And we know Apple enough to know that that's not true, but that's why for stocks you're less familiar with, looking at the monthly chart and then relating that to the weekly chart and the daily chart makes a ton of sense. Joe Rabel, who is a fellow Stock Charts contributor, literally wrote the book on multiple time frame analysis. I think it's a well done book talking about this idea of thinking about multiple time frames and what makes sense and why you want to consider them. On my shows, right, we often just stick with the daily chart just for time and simplicity. But if I'm actually thinking of something for my own portfolio, I usually look at the daily chart and the weekly chart and then kind of a short-term chart like the last couple months. I look at the daily chart, 2-year daily chart from me with the timeframes I'm looking at with my investment horizon of 1 to 3 months. 2 years is a really good kind of sense of what's happening and where we're at relative to where we've been. But then I usually look at the weekly chart just to see, is this something that's really been compounding gains over multiple years? Or is this sort of a new development that we've seen in the chart here more recently? And then less common, but sometimes I'll look at a longer term monthly chart and just think about how this stock has done through previous bull and bear cycles. This is a stock that has done well through bear market phases. This is a stock that tends to outperform when the broader markets are weaker. And only by looking at longer term data can you really start to understand that. So for simplicity, again, I mean, we often on the show just kind of look at, this one chart, and I'll make some analysis from that. But if I'm actually putting something like this into my portfolio, I'm going to consider other time frames, and then all of a sudden look at the short term as well. Look at a 3-month chart or even an hourly chart to just think about tactically, is this the moment where I feel like it's actionable to take a position, or is there some signal I would wait for on the short-term chart to actually pull the trigger and get into it? So I'd strongly encourage you to consider multiple timeframes and be thoughtful and deliberate about how you relate different timeframes to one another. If you've never done that before, you look at a daily chart and a weekly chart. And then if you feel you tend to need more information, start looking at monthly charts. If you feel like you need more granularity, look at hourly or 5-minute charts. And then over time, you'll become more and more familiar with the sets of charts and timeframes that you need to look for to answer the questions you're trying to answer. Folks, I want to thank you guys so much for joining me here today on a Friday afternoon mailbag episode of Chart This. Again, I'm Dave Keller with Market Misbehavior. Thanks for all your support, your great feedback. Really excited to have the show going here. Very excited to have the podcast back up and running. As a reminder, we've had some really good podcast interviews here in the last couple of weeks. Just this week, we released discussions with Ari Wald of Oppenheimer, Mike Turner of Turner Capital Management. I have one with Adrian Day of Adrian Day Asset Management, hopefully queued up for you into the weekend. And great conversations. Hopefully they make you think and just help illuminate some areas of the market that you may be less familiar with. For Market Misbehavior, I'm Dave Keller. Have a great weekend. And remember, it's always a good time to own good charts. Bye, folks.